It is important to understand the relationship between economic cycle, credit cycle, the pendulum of investor psychology, and distressed asset cycle during bull and bear market. But first, we will learn about each cycle individually. An economic cycle, also known as a business cycle or trade cycle, refers to the fluctuation of economic activity within an economy over a period of time. These fluctuations are characterized by the expansion and contraction of economic output, employment, and other indicators of economic health. Economic cycles are typically divided into four stages: expansion, peak, contraction, and trough. During the expansion phase, indicators of economic health increase as businesses and consumers spend and invest more. The peak phase represents the high point of economic activity where growth slows and the economy begins to slow down. During the contraction phase, indicators of economic health decline as businesses and consumers spend and invest less. The trough phase represents the low point of economic activity, where the economy begins to recover and grow again. A credit cycle is driven by the availability and cost of credit in an economy. The credit cycle is characterized by periods of expansion and contraction in credit availability, which in turn drive fluctuation in the economic growth. During the expansion phase of the credit cycle, credit is readily available and relatively inexpensive, leading to an increase in borrowing and spending by both businesses and consumers. This can fuel economic growth as increased borrowing and spending can lead to increased investment and job creation. However, as the credit cycle progresses, credit becomes less available and more expensive, leading to a contraction in borrowing and spending. This can lead to a slowdown or even a contraction in economic growth as businesses and consumers have less access to the capital they need to invest and spend. The pendulum of investor psychology refers to the tendency of investors to swing between optimistic and pessimistic attitudes towards the financial markets over time. This pendulum-like movement is driven by a range of factors, including economic conditions, political events, and shifts in market sentiment. At one extreme of the pendulum, investors may be highly optimistic with a strong belief that markets will continue to rise and that investment opportunities abound. This can lead to a bull market characterized by high level of investment activity and rising stock prices. However, as the pendulum swings towards the other extreme, investors may become increasingly pessimistic with the belief that markets are overvalued or that a downturn is imminent. This can lead to a bear market characterized by low levels of investment activity and declining stock prices. The pendulum of investor psychology can also be influenced by herd behavior, where investors follow the crowd rather than making independent decisions based on their own analysis of market conditions. This can lead to market bubbles where prices are driven up to unsustainable levels and subsequent market crashes when investors collectively realize that prices are overvalued. Understanding the pendulum of investor psychology is important for investors, as it can help them to avoid getting caught up in market hype and to make more rational investment decisions based on long-term fundamentals rather than short-term market movements. The distressed debt cycle refers to a pattern of events that can occur in the financial markets where companies with significant level of debt becomes unavailable to meet their debt obligations. This cycle is driven by a range of factors, including economic conditions, changes in interest rates, and shift in market sentiments. The cycle typically begins with a period of economic growth, during which companies may take on large amount of debts in order to fund expansion or other strategic initiatives. However, as economic conditions deteriorate or interest rate rise, some of these companies may begin to struggle to service their debt obligations. As these companies become more financially distressed, their debt may be downgraded by credit rating agencies, making it more difficult and expensive for them to borrow new capital. This can lead to a downward spiral in which the companies are forced to cut costs and sell assets in order to meet their debt obligations, further reducing their ability to grow and remain competitive. Understanding the distressed debt cycle is important for investors as it can help them to identify potential opportunities and risks in the financial markets.